Hello, everyone. Today on the final bar, I'm joined by Ari Wald from Oppenheimer, joining us from New York. We're going to talk about this environment, balancing the long-term trend with the short-term fluctuations. If you like volatility, uncertainty, rapid changing of direction, this week probably does not disappoint, with Monday's distribution matched by yesterday's rise and then today's follow-through led by the cyclicals. What does this mean for the overall environment as well as the FAANG stocks? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets using the power of technical analysis, using the toolkit of the technical analyst, the technical strategist, to make sense of things like price, breadth, and sentiment. There's so many conflicting narratives, so many reasons why the market could or should go up and down on any given day, any given month, any given year. Our goal is to cut through all the narratives and just focus on the trends. What is the price telling us about the actions that investors are actually taking? And when you look at Friday into Monday, it was a clear pattern of distribution, with the breadth very negative, with an acceleration to the downside, with people thinking all of a sudden about very long-term downside targets on the S&P. All of a sudden, 2 days later, we get a bounce back there. And the challenge right now is that sort of bounce will make everyone happy. If you're bullish, you feel redeemed, like things are just getting right back to where they were. If you're negative, you see this as the dead cat bounce of sorts, right? The short-term rally before another further distribution. We'll try to make sense of which of these we're facing with right now. We have great guests on the show. I'm excited to talk to Ari Wald again a little later in today's show. Coming up later this week, tomorrow on Thursday the 22nd, we have Jonathan Krinsky from Baycrest Partners. Next week on Tuesday, Mary Ellen McGonigal from MEM Investments. And then on Wednesday the 28th, Cliff Droke from the Cabot Wealth Network coming and joining the show again. Also next week, we have our next episode of The Pitch. On Tuesday, the 27th, The Pitch is our monthly effort to bring 3 strategists together, each pitching 5 ideas for you. It's a lot of fun. I'm going to moderate a great discussion with Greg Schnell, Jeff Hughes from JWH Investments, Mark Newton from LL Newton Advisors. We'll have a great discussion with each of their picks and then discuss them as a group and see what themes we can tease out of their takes. Should be a lot of fun. Go to stockcharts.com/the pitch for more information on that event next week. Let's continue on with our market recap. So as I mentioned, it's all about a balance between the long-term and the short-term. For me, the long-term signal has been fairly cautious for a while. As we talk a lot about on the show, we have a market trend model we usually refer to every Friday as part of our weekly wrap episode. And you can see for me the medium-term model, which is essentially the weekly PPO or the weekly MACD, which is a basic trend following mechanism using the weekly data and driven by exponential moving averages, that actually turned negative for me in May, suggesting, and again, for me, it's a general risk on versus risk off. Should I be thinking more about potential reward, potential upside, or potential risk and potential downside? It's told me to lean more cautious, which is why when we start to see the distribution that we've seen end of last week, at the beginning of this week, seems absolutely reasonable. The question now is a short-term, or differentiating the short-term pullback versus something longer term. And one thing we have absolutely seen on the chart of the S&P 500 is the importance of the 50-day moving average. The S&P has closed below its 50-day moving average a grand total of 2 times year to date so far. Once was in March, and the next day we closed right back above it. The second time was in mid-June, and the same thing. The next day we closed right back above it. Earlier this week on Monday, we traded down to the 50-day, but actually closed just above that. So that moving average, that 50-day moving average, or the 10-week moving averages, as many refer to it, overall still has held very well. And in general, I tend to think of as a trend follower. A trend is in play until proven otherwise. And until a chart like this breaks its 50-day, it's hard to be that negative about what's going on. However, though, underneath the hood, this is where it gets into some of the thematic stories, some of the ideas behind what is causing the price to do certain things. And arguably, if you look at certain charts, it represents that a lot of stocks are already in the correction mode, right? They're only less than 50%, if I remember right, of the S&P members above their 50-day moving average. That's down from about 92 or 93% back here in April. So over the last couple months, the market's moving higher, but less and less individual stocks are regaining their 50-day moving average. Those are the kinds of balances that I think are difficult to strike. And I think that's the challenge all investors are going to be grappling with right now as we are sort of in the heat of the seasonally weakest part of the year. Let's look a little bit more at today's trading and see what actually happening on the 2 days. 2-day preview chart. You can see the strength yesterday, really the acceleration out of the open, and then continuing to chip away higher. It sort of just picked up right where it left off today with a continued upward move in the S&P, which finished up about 0.8%. The NASDAQ 100, right about the same amount, to be honest with you. So it's interesting that if you look at the FAANG stocks, they were not dramatically higher like some of the cyclical sectors were today. This was really about things like energy and financials, materials, arguably more in catch-up mode than it was the FAANG stocks leading things higher in this case. The small cap index almost actually did double the percent return of the S&P 500. So the S&P 600 up about 1.7%, and the VIX is back below 18. Very quickly on some other asset classes, interest rates continuing to climb now over the last couple of days with the 10-year yield around 128, and that was below 1.2 down to 1.1 just a couple days ago. So certainly seeing a short-term upside reversal at the very least. Bond prices, which had been in a very nice bounce, now starting to rotate lower, and the dollar index down about 0.25%. We're using the UUP as a quick proxy for that. Looking elsewhere, gold was actually down, but most commodities are stronger today. Oil prices certainly appreciating, which is what's causing the energy sector to be up about 3.5%. And speaking of volatility and sudden movements and acceleration to the upside for cryptocurrencies, you had Bitcoin testing the 30,000 level. It actually spent most of the day yesterday trading below 30,000. We've talked about, the importance of lines in the sand and key levels to pay attention to. Let's go to the chart of Bitcoin here very quickly, just to think about how that relates the short term to the long term. Here's the daily chart we've been working with for quite a while. Here's looking at the last 1 year. You can see how important this 30,000 level has been for Bitcoin over the really year to date. This is after the acceleration to the upside when Bitcoin hit 42,000 here in January, pulled back to 30,000, and then rallied. And this is where we pushed well above those previous highs, all the way up to the mid 60s. Here in mid-April. From there, we transition, I think, very clearly from an uptrend phase or a period of accumulation to a downtrend phase, a period of distribution. We've broken moving averages. We've broken trend line support. We've gone from a pattern of higher highs to lower highs. And the momentum overall, the big red arrow probably tells my main thesis here, which is just the evaporation of momentum. Every month, as Bitcoin has attempted to swing higher, the momentum has been lower and lower. And that is not what a strong bull phase is made of. That's more of a bearish configuration to that indicator. So at this point, the fact that we've bounced off of 30,000 makes a ton of sense, I would argue, from a technical perspective. We've hit that level a number of times over the last 6 or so months. We've bounced higher every single time, and we've not yet failed there. So expecting a bounce on a day like today, I think makes sense. What concerns me about a level like this, which keeps being tested and keeps being proven accurate, is what happens when 30,000 does not hold. What happens when you break there and investors realize that that is no longer support? That is when you can get the anecdotal flood to the exits, when people who have been buying in at 30,000 are now underwater, are starting to realize that it's not potentially going straight back up to the previous highs. And that's when things can start to get a little concerning. You could argue the same thing on the chart of the S&P, right? When the fact that we've tested the 50-day so many times, what happens if and when the 50-day doesn't hold? At some point, theoretically, the 50-day moving average does not hold, the price goes below it. I think a lot of people have been expecting that continued support, and when it doesn't appear as expected, that's when fear can run rampant. Very quickly on a sector basis, then we'll take a quick break. The energy sector, as I mentioned, leading the way higher with the XLE up 3.5% today, followed by financials and materials. Technology was actually fourth from the top, followed by industrials. What underperformed are really the defensive parts of the market: utilities, real estate, consumer staples. And the XLRE, the real estate sector, is actually a really interesting one. I was asked in a media outlet earlier today talking about sector themes and the chart of real estate. It's so funny, as the S&P has continued to move higher, the chart of the real estate sector, REITs, have been outperforming. It's been consistently outperforming. It's made a new relative high every month this year. So if you told me, if you had perfect foresight and you knew that the S&P would keep pounding away to higher highs every month, would I guess that the real estate sector would be outperforming? Most likely not. I would be picking other things that would be much more well positioned as traditional offense. But you see real estate, which again could be a yield play because you're not getting as much from fixed income. So maybe you go to a more income oriented sector like real estate. But the fact remains, this is appreciating on a monthly basis, continue to push higher. And as we've seen with the S&P, I would argue that trends are in place until proven otherwise. Very quickly, because we're seeing the rally in financials, this is what is why the market, I would argue, at this point is at a very critical moment. We've seen the rotation from financials leadership through May into June, through financials lagging the market, which is what we've seen over the last 8 weeks or so. We've now tested support on the XLF a number of times at 35, which is where we found resistance back here in March. We're bouncing this week so far. We're now back up to the upper end of the range we've been in for the last month. We are trading up to a descending 50-day moving average. And my question is that the bounce before the rotation lower? And what would tell me that that is absolutely right is a breakdown of 35 on the XLF, which may be a key level to watch. We need to take a quick break. We'll be back with Ari Wald from Oppenheimer. See you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure to have you join us every weekday after the close, now live at 4 p.m. Eastern, to break down the action of the markets, help you try to make sense of what's going on around you as an investor. A couple quick comments, then we'll get to my guest, Ari Wald. First off, if you have questions as you're analyzing your own charts, please let us know. I think one of my favorite parts of the show is the interactive nature of it, being able to hear from you, things that you're running into as you're trying to apply technical analysis in your own trading. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video that you're watching. We would love to hear from you. Answer one of your questions in our next mailbag segment, which will be on Friday's show. Also, as a reminder, go to stockchartstv.com, use your email, set up a free account. You can start watching all of our fantastic content, some of our great shows like The Final Bar and The Pitch, wonderful guests like Ari Wald and many others who know their stuff, and also all of our great special events that happen during the course of the year. Go to stockchartstv.com. We are also on all the app stores. Just use your mobile device and search for StockCharts TV on demand. I want to welcome on today's guest, Ari Wald. Ari I've known for a number of years, and I respect him and his work a great deal. Ari's the Chief Technical Analyst at Oppenheimer, coming to us from New York. Ari, welcome back to the show.
Thanks for having me back. As always, Dave, great to see you.
It's good to talk to you, my friend. And, you know, when we're talking about this market, you and I were speaking before things started with the show today, you know, how do you balance sort of the long-term picture with the short-term disruption? And if the phrase uncertainty that comes to mind as I'm thinking of the volatility that we're seeing here, start us with what you're seeing. Talk us through your perspective here.
Yeah, the word we've been using is cross currents, and really kind of based on time horizon. You know, the first point for us is that the bull cycle is intact. I think probably only halfway through as well. I think there's another year plus to this. The second point to that is, though, that our feel is that tactical conditions have become less favorable. In fact, we just on Friday submitted probably the most cautious report we've written in a number of years. And I think that just states, in our feel, is that with poor seasonals upon us, there will be a better buying opportunity as we think later in the third quarter. So I brought a chart that I think nails both those concepts in one. It shows the percentage stocks above their 200-day moving average on the New York Stock Exchange. Now that number has dropped from the start of the year at 90% down to 70%. And I think in a bull market, the better opportunity comes closer to 50%. And with poor seasonals, I do think we get that, and given some moderation that we're seeing in some of our other indicators. The positive and the silver lining is that 70% reading is still an exceptionally positive reading that's been followed by above average returns 6 to 12 months later. I think it argues that the bull is intact, that the more worrisome condition is when you get a new S&P high and it's undermined by a reading below 60%. So, that marked the top in 1999 and 2007 and 2015 and 2018. We see the most similarities between 1996, 2004, and 2010. I know you've been talking about 2010. Years there were some ups and downs, and I think you want to buy the downs.
It's a great chart, and I love how it combines the short term and the long term. And you're right. I mean, how bad are things if still 70% of the New York Stock Exchange members are above their 200-day moving average? That's totally fair. I mean, then the next question is, what do we do about it? Chart number 2 is looking at growth in particular. Talk us through this one.
So yeah, so our actionable idea here is not to go to cash, but instead to kind of tilt and make a more concentrated bet on US stocks, large caps, and high earnings growers. So we have the various ratios in this chart. We're making the case that the tide is turning towards those themes. What do they all have in common? Well, a higher weighting to the technology sector, the benchmarks that are working there. And we see this convergence of macro trends supporting that trade as well. Specifically, I think of interest rates and commodity prices as really being the key drivers of these sector rotations. And our view is that both those assets are going to be oscillating in a range. I think US rates are anchored to even lower rates overseas. They're oversold, probably due for a bounce, but I think there's a ceiling. And I think commodity prices, you got a more stable dollar. I think that's going to limit both inflationary pressures and commodity prices. So the attraction with tech is that it's been able to withstand those oscillations. It's actually shown a zero correlation to both those themes and has also participated in a pro-cyclical advance. It is not a safety trade. Tech typically outperforms in a rising market environment. So our feel is that it won't be the top performer when rates are swinging higher and the market's embracing beta as it's been the past 2 days. But we do think the sector should continue to post some of the steadiest returns through the course of the cycle.
It's a great set of charts, Ari, and I can't disagree with the points that you're making. Just we have time about 30 seconds for one more question. When you're looking at a chart of the S&P 500, as I mentioned earlier in the market recap, we had a situation where the 50-day moving average has held a number of times, and we're testing it again this week. If we do see a little bit further weakness in the short term, if we do break the 50-day, is there a line in the sand? Is there a level that you would be eyeing that would tell you, forget about the long-term story, the short-term pain is so severe, we really need to get defensive? Is there a point of no return that you would identify that tells you lights out, we need to be in cash, or we need to get defensive, or how would you think of that?
Right. Well, I agree with the 50-day average. We've been kind of using that as the barometer. When does the correction come, now or later? I think if you drop below the 50-day, around 42.50, that does mark the start of the correction, and we defended it nicely this week. In terms of that correction, I'm thinking in terms of an 8% pullback. That's been the median drawdown through the course of the last decade. So I do think we get that deeper setback to 4,000. And then as far as when to get a little bit more concerned, for me, it's all about what does the subsequent rally look like. If that next, if we break down and then the next rally is really low quality with very few stocks, I think these tops take time. So I think we're still a ways away to getting to that point where I think the evidence would suggest a deeper bear cycle, if you will.
I love it, Ari. I was told early on, tops are a process, not a moment. And I love your description of what could play out. Ari, listen, thanks so much for coming on the show. As always, appreciate you sharing your expertise. Stay safe, be well. We'll talk to you again soon.
Enjoy the summer, Dave. Thanks for having me on. Take care.
Thanks, Ari. That's Ari Wald. There's the chief technical analyst at Oppenheimer in New York. And you can see, hopefully, as he's describing his expertise, why I've always enjoyed Ari in his work and talking with him about the markets. I miss being at a large institution and having the opportunity to chat with guys like Ari way more often. But I think if you heard about that, what I love was his answer to that last question. We talked about, where would you want to get more defensive? And his, I thought, very thoughtful response was basically to see what happens, see what that next bounce looks like. All right, here's a potential downside objective to 4,000, 40, 50. I think he said 4,000 in particular. But, if we do get there, the question is what happens next. And I think that focus on price behavior and leadership themes as the market's evolving, I think more often than not, can point you in the right direction. Let's continue on with this show with our next segment called ETFs Engage. What we love to do occasionally is break down the ETF landscape. This is an area of the markets where I find a lot of people are using ETFs, but not enough do you do the due diligence to really understand the exposure that you're getting. And what we try to do is a bit of myth busting and a bit of dispelling some incorrect thinking about what some of these ETFs are actually doing. One of the questions I had recently was actually about the FAANG stocks. And one of the charts that we've shared, if I can get to it very quickly, was looking at what I call the FAANG stocks. And this is sort of the FAANG plus Microsoft. And, I have Netflix in there as well as what else do I have in here? Microsoft, Netflix, both Amazon and Apple kind of all grouped together along with Alphabet and Facebook. Here's the overall performance of the FAANG stocks. And, when you think about whether we are in a topping process or whether this is just the short-term pullback before the resumption of an uptrend, the reason why I would say at this point, upside is most likely limited are charts like this, the FAANG index, the FAANG Plus index, which we're looking at here, which is sort of FAANG and other FAANG-like things like Tesla and some Chinese internet names, a couple of those were in there. It's a mixed bag of things, but sort of FAANG-ish types of stocks. This index basically made its peak in February. It retested that peak end of June, early July, but has failed so far. So really hasn't been able to eclipse the peak there. So according to the FAANG Plus index, the rally, the trend was into the February high. And from there, it's been sideways. Now, some of the stocks have continued in their uptrends, like Facebook, absolutely right, have been in a consistent uptrend. Alphabet may be the best example of that, threatening a new all-time closing high again today. Overall in pretty decent uptrends, but others not so much. And if you look at the chart of Apple, if you look at the chart of Amazon, they are potentially failing to break out. These are I would say on the failed breakout watch, testing previous resistance, but not really pounding through there. Amazon actually breaking above it and then coming right back down and now testing the resistance level from above. Netflix actually with an earnings release this week, rolling down and actually selling off today. So the question is, how well can the markets hold up without the FAANG stocks participating or even driving the market higher? So the question I actually got, and sorry, that was an extensive intro to the question, which is basically what ETFs can I use? Is there a FAANG ETF? And this is one of those things where it's so funny when you ask me what the FAANG ETF would be, I'm going to answer this one, which is an ETF you're probably very familiar with, which are the Qs. I would argue if you want exposure to the FAANG stocks, the Qs pretty much do it. And if you look at the holdings of the Qs, and again, I'm just looking quickly at the current holdings, about 11.5% Apple, 10% Microsoft, 9% Amazon, and then we're down to 4% Alphabet, 4% Google, 4% Tesla, 3.5% the other Google, NVIDIA, which you could argue is maybe a FAANG stock on its own. Finally, get to PayPal and Adobe, which I've never heard people incorporate into the FAANG group, and that's it. And you're down to like the 10th holding. So that top group is probably 40% of the ETF, maybe a little bit more. Actually, it's more like 40 to 50% are that group of stocks. So the FAANG stocks are much of the weight of the Qs because it's a cap weighted index aiming at some of those larger names. So Apple on its own is about 11.5% of the performance of the Qs. So when you're thinking about what ETFs can I get exposure to the FAANG stocks, anything that has a big exposure to those spaces and something like the Qs, while we think of it as the NASDAQ 100 index, it's a broad group of 100 stocks. It really isn't. That's very similar to saying the XLY is accessing a big, broad universe of consumer discretionary names. It's really three stocks that are, 45, 50% of that ETF. I was asked in particular about the FDN, which is another ETF. The FDN is basically the First Trust ETF, the Dow Jones Internet Index Fund, and that also has plenty of exposure to the FAANG stocks, about 10% in Amazon, 7.5% Facebook, and then you're down into PayPal, Alphabet a couple times, Netflix, and so forth. So the top holdings are very similar, but actually, if you look at the Qs, the concentration is much more in the FAANG stocks than it is in the FDN, which people think of as more of a FAANG ETF. So my answer is you don't really need to look that far to find an ETF that has exposure to the FAANG. There are plenty of online tools that can help you if you put up an individual name to find what ETFs have a lot of exposure to that. But I would just remind you, make sure you do your due diligence on something like the Qs. It's not as broad of an exposure as you may believe it is, because it's an index and it's something that's widely quoted. You are literally following the FAANG stocks, I would argue, if you're looking at the Qs. Having said that, let's spend a moment looking at the Qs, and let's actually look at this chart. This is part of my equity market index package, and it's sort of the main way that we're looking at some of these ETFs, and I'm actually not seeing the Qs out here readily available, so we'll bring it up here and pop it in this way. So here's the situation, right? What is the current environment? If you look at the S&P 500, I would say you're seeing the breadth divergences. I would say you're seeing the fact that while a good number of stocks are still above the 200-day, less than 50% are above their 50-day as of yesterday's close. That's relatively weak within the S&P. When you look at the Qs, though, a bit of a different picture, because we're really accelerating to previous highs. Coming out of that overbought region, and the Qs recently became even more overbought than the S&P 500, remained there for a longer period of time, but now back out of that overbought region. It's interesting, by the way, my guest, Ari, talking about the technology, the growth trade, and I'm drawn when I'm thinking of the Qs, when I'm thinking of the FAANGs, I'm thinking of a chart like Microsoft. And again, if you didn't know that the market was volatile, that the market was uncertain, that there was a period of dislocation over the last couple of weeks, you're not seeing that from a chart of Microsoft. And where do you hide out? Where do you park assets in a period of uncertainty? I would argue places that are outperforming, that are not showing signs of distribution, and something like Microsoft certainly seems to fit the bill. We need to wrap the show, go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 and an indicator called the Zweig Breadth Thrust. This is named after Marty Zweig, who's a famous macro strategist. And there are a couple, we don't have time to go too deeply into this. If you're interested in this, by the way, go to my YouTube channel called Market Misbehavior. I recorded a video a couple months ago about this Zweig Breadth Thrust and what it actually represents. But basically, when it goes below 0.4, this is a moving average of advancers versus the total number of stocks in the New York Stock Exchange. When it goes below 0.4 and then breaks back above, which it does, and then within 10 trading days gets above 0.6, 0.62 is what I've often heard as the signal, that would indicate a breadth thrust, basically a period where you've gone from negativity very quickly to an acceleration to the upside. That tends to be a very bullish signal. We didn't quite get it October into November of last year, but really, really close, and close enough to indicate the renewed strength in the market. So if I'm trying to find charts that would help me stay true to the fact that if the market keeps pounding higher, I still want to be invested, I don't want to be too cautious, this is one of the charts that may tell the story of the next couple of weeks, and I'd encourage you to follow it. Chart number 2, my guest Ari Wald did a great job talking about the percent of stocks above their moving averages. He actually talked about the New York Stock Exchange, which was down to around 70%. On the S&P, it's still around 86%, which is still very, very healthy. But if you look, only 50%, less than 50% of the S&P finished the day Tuesday above their 50-day moving averages. So it's 50% down from over 90% just a couple months ago. So that indicates the rotation where so many stocks have not been holding their 50-day. They've actually been breaking below it. And I think seeing if that remains muted tells you that there are less and less stocks participating, and maybe a limited number that are holding things up. Finally, we talked about financials bouncing to the upside and potential concerns there about the chart. I think we'll finish here with the energy sector. Similar story, right? A lot of these cyclical sectors have essentially been range bound, but they've pulled back to previous lows. We saw that with the XLF bouncing off a key support level. You will also see that with the XLE. If you look at the lows in March and April, that lines up right to where we finished this week. The RSI is oversold for the first time since last September. Right now, we're bouncing. My question is, do we get back to this 50-day moving average? That overall, and if we're able to break out of that range, that could indicate a reassertion of leadership from a cyclical group that's been struggling recently. However, if we break down through 46, if we undercut these lows from April and then from earlier this week, I would be very concerned about the potential downside in a key group within the cyclical grouping of sectors. Folks, that is our show for today. Thank you so much for joining us every weekday after the close, 4 p.m. Eastern for our show. A special thank you to Ari Wald joining us from Oppenheimer in New York. As a reminder, go to StockChartsTV.com to access all of our previous content. We're uploading new content every day, as well as our special events like the Charting the Second Half special that went on in recent weeks. A lot of fantastic content to help you navigate this uncertain environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.